Welcome back to Simply Money. Today we're going to be looking at the hidden cost of fees. What is the impact that these financial advisor fees or mutual fund fees have on your portfolio? A lot of times we don't give it much thought because a financial advisor fee may only be 1%. A mutual fund may be 0.5% or 0.75%. And you think, well, that's not a whole lot of money. And especially when we're first starting out, you make an initial investment and then you're adding to that monthly or annually, and you're not seeing a huge amount of dollars coming out. The financial impact doesn't seem that high. But as that portfolio begins to grow, you can begin to see the impact it's having. What we're going to do today is compare what an advisor fee impact can have on your portfolio, what a mutual fund fee can have on your portfolio, or if you're unlucky enough to have a financial advisor who's also investing in mutual funds, you have to combine both of those fees because you're paying your advisor the fee, and the mutual fund still has a fee because it's actively managed by whoever is producing that mutual fund. And then we're going to look at what an index fund, an S&P 500 index fund, would actually gain you in your portfolio. We're going to compare these different items and different fees and how it truly impacts you by the time 20, 30, 40 years down the road when it begins to grow and you see the impact in a much larger scale. Big thing to remember is 92% of financial advisors do not outperform an S&P 500 index fund. If you were to give 100 advisors the opportunity to pick their stocks, pick their funds, etc., and then you had 100 of people investing in an S&P 500 index fund, 92% of the index fund, which is passively managed and much cheaper on expense ratios, would outperform the financial advisors and the managed funds. So let's take a look at this. If you look at the chart up here, these are numbers that we can change, and we'll be changing those throughout this scenario, but we're going to start out with a rate of return of 7%. We're using an advisor fee of 1%. So when you look on this advisor fee column, that's taken in consideration this 1% fee. We're going to use a mutual fund of 0.75% fee, which in this column here, column E, you would see that impact using the 0.75% mutual fund fee. Column F is combining both of these. So in this current situation, column F, you have 1.75% in your fees because you have the advisor fee and they're investing in a mutual fund. So you have the mutual fund fee. So that's combined. And then in the index fund, we're going to be using to start out a 0.04%. And that is using this VFIAX index fund as an example. As you can see, the expense ratio is 0.04%, and the rate of return is, since inception, has been 7.16%, so we put the 7% there. We're going to also use the initial investment. If you were starting out on year one, that you invested $10,000, and then you annually invest $5,000. We're going to look at that and see what that works out to each and every year. So as you can see here in year one, it's not a huge difference. An advisor fee versus just an index yourself, you saved about $96. If you have a mutual fund fee versus an index fee, you're not even saving that. You're saving, what's that, $51. If you combined and you have both of them, then you see a little bit more, you're saving about $151 here by not having an advisor who is investing in mutual funds. So again, that's a very small impact. You're not thinking much about it. You may get your quarterly statement. You might see it off to the side. You may not even see it because there's so much information on your quarterly portfolio statements. There's so many numbers and percentages going on. A lot of people don't even pay attention. They just say, well, I trust my financial advisor. That's what I'm paying them for. What is the impact of this? So let's just look at somebody that maybe for 10 years have been doing this. And you look down here, now we start seeing a little bit more of a difference. So at 10 years, with an advisor fee of 1%, your portfolio would have grown to $83,800. And over here, the index fund is at $80,000. And so you're down almost $5,000 that you could have continued to have in your portfolio. Again, not life changing. Again, not going to make a huge difference in your retirement. If you were to stop after 10 years, yeah, you may have done a little better by doing index funds versus having an advisor do it for you. Or if you can look here, if you had an advisor investing in mutual funds, you're about $8,200 difference here. It's a significant amount, but again, it's not life changing that's going to break your retirement plans. But what happens is we forget about the fact that when you retire, you still have that money probably with an advisor, and they're continuing as you're drawing down your portfolio, as you're taking money out of your portfolio to live on, they're still getting their fee. If you have mutual funds, they're still getting their fees. So not only are you drawing down your portfolio, maybe you're following a 4% rule or a 5% rule. You have to remember if you have an advisor 1% fee, you're not drawing down 4%, you're drawing down 5%. If you have an advisor who's put you in mutual funds and you're drawing down 4% and you have a 1.75% fee between the two of them, now you're drawing out almost 6%. So it can make a huge difference, not only as you're trying to accumulate your wealth, but as you're drawing down your wealth and living on that in retirement. Those fees can eat away at your principal and shorten the ability you have to retire or the ability you have to leave an inheritance to your kids, grandkids, or favorite charity. So again, at 10 years, you're not seeing a huge difference. I want to skip down here. Let's say you're 25 years old and you invest for the next 40 years. When you're 65 years old, you put $10,000 in at 25, and you invest $5,000 a year for the next 40 years. We're keeping this simple. We're not putting inflation in it because that doesn't change the impact of these fees that we're looking into. Let's scroll down here. Look at this at the end of 40 years. So at 65, you've been diligent, you've done your job, you have been consistent, you've been disciplined, you've invested on a regular basis, whether it's in your 401k, whether it's in your IRA, but you have an advisor who's been charging you a fee. That 1% fee, you can see here, you're at $876,000. Again, that's great. You've done a great job and you've saved and you've invested and your nest egg has accumulated to a very substantial amount. Now, if you had the mutual fund by itself, again, it's a little less than an advisor. You picked your own mutual funds. You have $937,000. Again, a great job, accomplished, very good job. But if you're paying an advisor and they're investing in mutual funds, look where you're at. You're at $719,000. How does that compare to just picking out an S&P 500 index fund? You would have $1.135 million. Look at the difference. Just paying an advisor, when you go to retire, you're almost $259,000 less than you would have had by just putting it in an S&P 500 index fund. Simply by investing yourself, by putting it in a low expense ratio index fund, you're 1%. Remember, back year one, it was $100, $50, whatever it was. It was very minimal, and you're like, that's not a big deal. Look how that compounding financial fee has added up and what it has taken you. This $258,000 is what's buying your financial advisor their beach home. This is what's buying them their nice car. This is what they're taking their vacations on. Now, if you use mutual funds, even if you're doing it yourself, you pick mutual funds, which are managed funds, instead of an index fund, which is a passively managed, meaning it follows the index versus a group of people deciding, oh, now we're going to sell this, now we're going to buy this, this is what the fund's going to be made up of. They're making the decision, so they're charging you that 0.75% or 0.5% or 1%, whatever their mutual fund expense ratio is. Again, you're almost $200,000 less in this scenario because you're trusting other people when to buy and sell or change the fund, where an index fund just follows the index. It's passive. You don't have to do anything. You don't have to be an advisor to do it. You pick it, you stick with it, and let it go. And S&P 500, 92% of the time, has beaten mutual funds. So why would you want to take that 8% chance that you might do better than this, knowing that 92% of the time you're going to do worse, and this is the amount of money you're looking at? Now, just imagine you have a financial advisor and they say, I think you need to be in these mutual funds because these are managed, they're going to do great. They show you, look, at an average of 8% return, et cetera, 9% return, whatever the case might be. They sell you on it. They convince you, yeah, let's go ahead and invest in that. They charge their fee. The mutual fund charges their fee. At the end of the 40 years, you're down $400,000 compared to where you would have been if you just put it in an S&P 500 index fund. Now, again, I'm making this very simple. This is not financial advice to say, go put all your money in an S&P 500. Don't diversify anywhere else. I'm just showing you an example how index funds that are low cost can save you or create for you greater wealth. Now, this is only showing the accumulation stage. Again, it's not showing the withdrawal stage when you're actually living and depending on this to last you until you die. That is an even bigger impact that we can show on another video. But for the point of this video, I want to show you, I want to stress impact that these small percents that you're not even thinking about, especially when you start out, on how much they're eroding your accumulation of wealth. So let's change a couple things. Let's go with one of my favorite S&P 500 funds, the FXAIX fund. Fidelity's very low cost expense ratio. Look at that, 0.015%. So we're going to put that in right here, the index fund. We're going to put 0.015%. Look at that annual return. Since inception, 10.5% return. We're just going to put a flat 10% return. Now this return, we're assuming that, so we're comparing apples to apples, that these mutual funds and advisor funds that they're picking have done equal to the FXAIX. But remember, 92% of them do worse. They do worse than this. But I'm giving them the benefit of the doubt, even if they do the same, how much it would cost you. This doesn't take in consideration if they only get 9% because they're not following the index. We're trying to give them the benefit of the doubt that these 8% that can do the same or better. We don't have the better, but we definitely don't have the 92% that have done worse. So the 10% return, let's look at what happened. We're not going to go down the early years. Look at the difference. Now, if you have an advisor and you're paying their fee, instead of $2.6 million, you have $2 million. Again, at $2 million, most people are like, that's great. I'm excited. I'm so happy. I can retire. I'm in great shape. Because we look at this. We don't look at this. You basically just gave your financial advisor, through the course of your life of investing, $650,000 to pick funds that you can go and pick yourself. Let's look at the mutual fund. You got a group of people saying, oh, let's add this stock. Let's take that stock out to the fund. Let's keep managing it. 92% of the time they do worse. But even if they do the same and get the same 10%, their 0.75% fee costs you $500,000. You have lost $500,000 of potential wealth creation by paying that 0.75% fee. Seems so small, less than a percent fee. Again, if you have to do both, you have an advisor that's picking mutual funds and they do equal, you've lost $1 million. Now, if you go to retire and you have $1.6 million, you'd probably be very excited. But think about what you could do, the difference that this made by that 1% advisor fee, that 0.75% mutual fund fee, by putting it in a low-cost index fund. Look at the compounding impact that has. You don't think small percentages mean a lot, but when you're compounding over a long time, because time is the essence of wealth building, that 1%, that 1.75% erodes your wealth building tremendously. Again, you're up here looking at this. Oh, it's only $98 to pay my advisor. Oh, it only costs me $73 to have a mutual fund that's managed. That doesn't seem like much, and we can swallow that. That's something we can deal with because we don't think about compounding with, that's not a big deal. It's not much. Small amounts compounded long term equal huge returns. I want to show you this one more time. Look at the impact. 1% costs you $650,000. 0.75% costs you $500,000. Combining them, which a lot of people do, they have a financial advisor who invests in mutual funds, and you have both fees to pay, you're down $1,000,000. And that is if they were to be able to get equal to the index fund, which 92% of them do not. Why are we paying our financial advisors this much? If you do go to a financial advisor, get a fiduciary and get a fee for service. They charge you for their time that they spend with you. They can advise you, they can give you insights. Make sure they're a retirement planner. They can give you tax advice, CPAs. Make sure you're getting your money's worth out of that time you spend with them. It should be locked in. If I'm going to spend an hour with them, I'm going to check in with them twice a year. I should spend X number of dollars. That's it. Because the wealth accumulation, that's why we don't like it. We like the 1% here because we're like, oh, it's only $50. It's only $100. And they're saying, well, if you go to a fee for service, it's going to cost you $300 for us to sit with you and make your plan. And so $300, we're like, oh, we don't want to do that. Or whatever the amount is, it's usually higher than that 1% would be when you're first starting out. As we get down here, maybe into year 20, you can start seeing the impact relatively quickly here at this point. Again, it's not as huge. You're looking at a financial advisor, about $40,000, $41,000 it's cost you. That's a big chunk. But again, it's not life changing necessarily in your retirement. It's that accumulation as your wealth builds, as you continue, how it erodes in what you're doing. This is where if I go in year 40 and say, okay, it's my annual checkup with my financial advisor, he's going to charge me $500. I'd much rather fork over $500 than the $650,000 that it's cost me for them to just meet with me once a year still, whatever they're doing. They're not helping any. Please, please do your due diligence. Look into the fees that are being charged and make sure you're capitalizing on the rate of return. If you do index funds, make sure this amount, this index fund fee, this expense ratio is low. These are nice expense ratios, 0.06, 0.04, 0.02. Those are expense ratios. You'll see this 0.015 is very low, one of the lowest you'll see, and to get such high returns. It's an impact that will change your life. Make sure you do your homework. You control your destiny with your finances. It is up to you. If you enjoy these charts that show you things and how they impact you and how you can grow your wealth, leave me a comment down below. If you have a specific question, feel free to ask me. I'd be glad to answer anything I can. And hit that like and subscribe button so we can continue to provide these videos for you. And we will see you next time on Simply Money.